Hello and welcome to Money Control. Well, the market is mildly bullish this morning, but the overall momentum continues very strong. And today, to discuss and continue the conversation series we started about 2 weeks ago on how to navigate the all-time high and how do you ride the bull run, I have with me a very special guest in the studio, Samir Arora, founder and CIO of Helios Capital. Thank you so much, Samir, for joining me in the studio today.
It's such a long time physically here.
Absolutely, absolutely. So what's the mood like, Samir? Articulate what does this market really look like if you look at the last 30 years? And then what does the market look like if you look at just the last 3 years?
So I would think that in the last 25 odd years, the market has done very well. In dollar terms, it has beaten it has beaten all the big money centers like US, Europe, Japan, Asia, China, etc., emerging markets. In the last 5, 10 and 15 years, India has lagged US, but again outperformed other markets. So one thing I always stress is that I see people talking about how this is the best time to invest and how we are coming to a golden decade. That might be true, but if we can get the returns of the past 25 years, for the next 25 years, it is more than we can imagine, because the last 25 years we were number one. So the point being, the markets or equity markets need not be such a hard sell that because this is India's decade, because this is the future is now that you should invest. Generally, Indian market has done well for both bottom up and catch up and global this thing that we are the last of the emerging markets, big markets, and maybe we can say with higher confidence because of what is happening now that those returns can be replicated or even maybe exceeded a little bit. Sure. But generally last 25 years coinciding more or less with my career have been very good for the market and also for me.
But Samir, if you jog your memory, you will also see that from 94 to 2004, the market went nowhere. I mean, there have been periods when for many years, 7, 8, 10 years, the markets have been flat. And then you see a sharp, spike in 3, 4, 5 years or whatever. Those years were the
absolute best of our life. And I'll tell you why the index didn't go anywhere. But just to put in perspective, the NAV of the alliance funds were up more than 32% per annum for those 8 years. And the reason why the index did not go here, but the markets in general went up a lot, is because the index at that time was constituted by the older companies which were under attack because of liberalization. And the new companies which were in IT and these Hero Honda types and pharma guys who were just coming out in those days were not part of the benchmark. So the reason we beat the market by 32% per annum was because the index had the old tire companies and the steel companies and maybe Tata Motor type companies. And the wealth generation was happening in the new private companies that were set up in the early 90s, and then by like Z was up 100 times in 2 years. So that's why those were great markets, both from making good money and also on paper showing huge outperformance against a lagging benchmark.
Right.
Now, because there's not such a big transformation in terms of new companies coming in, the index is not that out of line with the new happening companies. But so 90s was actually not a bad time. It just looked bad from an index point of view.
So this is completely out of syllabus, but since you're talking about it, I can't resist my temptation to ask a follow-up question. So the markets today are starkly in contrast to what it was from, then. Index investing was hardly a thing. Money was not chasing index stocks as much as it is doing it today. Therefore, is there a case to be made for, what does this mean for active fund managers at all and active investing? Is it possible that this, money, more money moving into index stocks creates a bubble in index? And active fund managers, will continue to lag?
To lag, first of all, by design, half the active manager or active money has to lag, because the sum total of all the money with the active guys also is the market. So all cannot outperform. Sometimes we can all outperform because of buying non-index stocks, and then the mid caps do better. So if you have 20% mid caps in your flexi cap, you can beat, you have extra if you are beyond what the index may have. So by design or by construct, basically 50% of the money has to underperform and 50% has to outperform. But then there is the cost, the management fee, and in India's case more the distribution fee,
Yeah.
which is makes the fee higher. So therefore the 50% becomes say 40%. And then if you say over 5 years the same fellow has to outperform again and again. So that makes it maybe 30%. So big picture over 4-5 years, 30% of fund managers beat. And we are saying these numbers with smiling because we have beaten more or less over every 5-year period.
Right.
By a big number. So, but generally that is just by design. But it doesn't mean that you should go into an index fund, because a index fund, who will come and market to you beyond a point? Because index fund, the fees is such that effectively you are doing everything on your own.
Right.
So that's why practically it's not easy in a country like India, where people are even today choosing to go through a mutual fund distributor assisted route rather than a direct route, because they want their hand to be held, and rightly so. And secondly, I say jokingly that if your index funds does badly, which means the market does badly, who will you curse? Whereas if you pay us
That's hardly a reason to put money, because you don't.
If you pay the fund manager a piddly 50-60 basis points, if it goes badly, you can blame him for everything, including the index.
Correct.
Not just the performance relative to the index. It's part and parcel of anything. When you go to a IIT entrance, only 2% win or get a seat, but 98% try. It's the same thing with active investing. There is 2 or 3 parts to it. One is somebody came and explained it to you and convinced you to put in equities. And therefore that itself, asset allocation help. But if you are very clued in, very smart, you can go into the lower cost. If you think that this thing that you put in the markets, we all will benefit. It doesn't matter directly whether you put in any one fellow's fund or not.
Sure. And within this universe of stocks that we, that you look at, would you think today it is a better strategy to therefore construct your portfolio, or even if you're an average investor, to constrain yourself to index and take, I know you hate this word concentration, but take larger bets in some of those larger companies or newer entrants in indices,
so that's what I'm saying,
than non-index stocks themselves?
But that depends on which index you are taking. Because at some level, we are also looking at only index stocks, except that our index is 500.
It's a bigger,
500.
Bigger universe.
So that depends on you. But if you do only the large ones, then you are doing what we call high confidence in reasonable return. That then you are not discovering these stocks, you are choosing these stocks. So when somebody has HDFC Bank and the other guy doesn't have, it is not that we have more information on HDFC Bank, the views are different, which effectively means you are choosing these stocks, not discovering them by doing anything like groundwork or whatever you call it, primary, this thing. So if you choose that, you are effectively reconciling to reasonable return. By reasonable, we would mean if you can appropriately choose maybe 2-3% more than the index, but then you will not have any excitement in your life. Excitement will come by discovering. So the combo works that way, that you are doing some part which is the backbone, and then you are doing some because you are early, or you have a view on how this can develop. The thesis can develop or whatever. So individuals, I would think, if they have to do it on their own, first of all, why should they do it on their own? What is the fee which these poor fund managers charge?
That question I'm not going to
ask. It's like less than 0.5%, 1%.
Don't ask a barber when you need a haircut. So I'm not posing that question to you.
But if the barber's fee is very low, then you can say, what, बेचारा barber भी क्या लूट लेगा हमारा, even if he charges 0.5%. Because if you see the average investment of a mutual fund investor, I don't even know how much it is, but they say it's some 1 lakh, 2 lakh rupees average. So that means the guy is giving 5,000 rupees in a year. So he's giving 400 rupees a month to the fund manager. A big deal that somebody is, but collectively it adds up. So I would say it's a combo. If you are really good at it, you can even try and discover newer names, but mostly then you will choose the obvious names, and therefore your returns will be a little lower. But anyway, I would think whatever you do, whether you underperform or outperform, mostly you will do better than other things.
Sure, sure.
Because the equity markets are beating debt by 5-6%.
Right.
Most probably you're not underperforming by 5-6% per annum.
Right.
So that is, and plus the tax advantage is there in
Right.
equities in India versus debt.
Right. Sure. That is
So
undoubtedly.
either way, you'll be all right.
Sure. Now, just pulling back to the present day bull market. You and me have talked about this decoupling theory several times in the past, and every time we take this word, we really cringe. Now, this time, is it different? Because especially
Why
the
are
fact
we
that
decoupling? We are underperforming US.
no, I'm saying the overall trajectory. For example, whether you talk about the economy or flows coming into emerging markets. We've always believed that we are part of the emerging market index, and therefore, the entire region does well. We will get a fair share, sometimes less, sometimes more. But now there is this anti-China narrative that is also following the, in the real economic world, it was already happening. But even in terms of fund flows, the narrative around anti-China is gathering some kind of credence. So, do you think that will endure this time? Will it go on for some more time?
100%. But before that, we have actually we've never been coupled with Asia or emerging markets. For example, if you look at last 20 years, Chinese market is up some 2% per annum and India was up 11% per annum. So even though year to year it looked that all markets have to move together, imagine the difference between these two markets which look big picture similar. Secondly, now I think the thing is that people are really frustrated with China, and this we are talking about FII type. We're not talking about the supply chain, the guys who are also, whether frustrated, maybe they're not frustrated, but they
Just
are doing it from
de-risking strategy.
De-risking and making the supply chain more robust. But the stock market guys are actually frustrated because they thought they had made some good investments, whether it was in EdTech or gaming or maybe Alibaba or Didi or whatever, and they were hit directly by government policies, specifically targeted at those sectors and those companies. And also now because of geopolitics and because India is seen as being able to manage relationship with different guys, Russia, Saudi Arabia, Iran, and also US. The US institutional system is much more willing to say that they like India. For example, otherwise you would not read so many articles where upfront, like this Canadian pension fund or that University of California or somebody openly coming and giving interviews that we are not investing in China. That means the Western world thinks that China is not just an emerging market, but a strategic, let us say, competitor or threat or whatever. And that's why even like last week they said that NVIDIA cannot export these chips for AI learning to US. So ये direct है. So in that context, and because the FII guy has been hit with actual returns, we needed one more element which we have, which is that we should not say that we are beneficiaries of investors' frustration with China. We should say we are beneficiaries of investors' frustration with China, but separately also India merited more attention because we have done 3, 4, 5, 10 things that we have. Which is, let's say our inflation is in control, or that our currency or current account deficit is not looking that threatening for the near future and maybe for longer time, or that GST ho gaya, or that digitalization ho gaya, whatever. So it should be a combo, then everybody can justify, including the global investor. And so if they make the slightest shift, which they seem to be making, we should not think that we have to replace China, because that is too dramatic and unrealistic. We say that your weight in the index is 29 in emerging markets and ours is 14. If you make that new, forget about even selling your stock. In future you make your 29 into whatever, 20 or 25, or maybe some people are saying 0 for new flows for some time. Uska the biggest beneficiary is India, not Taiwan, which is the second biggest market, because it will be the same bet. And Korea, they are anyway saying might become developed. And also India, China look like this big picture, long term, buy and forget kind of market. So abo China ka, because that has been punctured, so India will get.
So this
Last one more. for the first time you might have over time FII and DI both wanting to buy.
Yeah.
Abhi last year the DIs were buying and those guys sold from middle of the previous year, which is 21, to end of last year, maybe 35 billion over 1.5 years. So that one day, and now it seems to be happening, that both have money and both are willing to buy it, and then you get the squeeze.
So two questions. One is this, this ex-China kind of indices. Are those benchmarks or indices seeing a lot of demand? Are overseas investors keen on investing? Because that might then mean that, a lot of flows that will come will directly have greater allocation to India.
That I don't know, because these things, there's some pension fund will decide, because they may have been overweight and now they don't want to put new money, because these benchmarks are not out yet.
Right.
But somebody could have made customized benchmark. But the fact that they are talking with their name, it's not anonymous guy said.
Correct,
that means
correct.
A, they don't care of upsetting China. And B, they are really frustrated. So whether they have actually done it or not, but on the margin, because so many big institutions are saying
Correct.
that there must be truth, and it is consistent with what you can separately see has happened to their returns in China over the last 5 years, and also definitely over the longer term. But we don't know yet. But one more thing is, I think that if this happens, you may not need an China index. You may invest in China or keep it in China. You may invest in India, and I'm talking about emerging markets.
Right.
Okay?
Right.
Then rest of the emerging markets, you may give some money. Why would you give to an index which has no China, and Korea becomes developed, and Taiwan is actually developed from a standard of living, but maybe not from a stock market point of view,
Sure.
but otherwise deeply connected with any issue that may happen in China. If China-Taiwan conflict is also one more thing, to bacha kya usme? So you might as well give to India also separately, and then say to everything else, which is Latin America and Middle East and all, the weightage itself would be small, and you can give it like that after some time.
Okay.
The emerging market itself might go away if, because the big two constituents, if people have a different this thing.
Okay. So how big a worry is this this reversal in yields that we are seeing in the US? Is that something that you are worried about? Do you think the market's factored in, it's done, dusted, it's not going to emerge again as a risk?
No, it will emerge, because they are saying that we want to increase 1 or 2. One will happen in July.
Correct.
And even the core inflation is not going down. And actually for a long time, Federal Reserve was effectively signaling that there will be no cut this year, but the market was saying that there will be cut.
There will be.
But I don't know why they were saying it, because you can't, unless there's a crisis. If the Federal Reserve says, I am not cutting, or my dot plot or whatever is saying no, and you say, no, you will cut. But why? I am telling you no, because the inflation is not coming down, and secondly, the target is 2. But that 2% also looks unrealistic going forward, because we had this systematic advantage of China basically, producing things cheaply and helping the overall world's inflation, and that is over. And secondly, now you have to make these obscene investments in environment friendly things, which are basically replacing old investments.
Yes.
So it is not it's solely for external factors and not economic factors. So that also cannot help inflation. So over time they may say that, okay, not 2 but 3, or they may not say it, but they may accept 2.5%, 3%. Because if you say that I will go to India, I will do near shoring, I will do friend shoring, you could have done that before if you were only looking at economics, but because it didn't make sense,
Right. Correct.
you went everything into China.
Correct.
So that has not changed.
Correct.
For many years, when somebody comes to India, he'll be paying little bit higher.
Yes.
That is why you have the PLI scheme to
Yes.
compensate for that. So therefore, they have to do. But today, I won't think that that has gone away. But it's just because now you might be again in the end zone, and because the unemployment has not come down. So, chalo, theek hai, let's move on 6-8 months. I would think next year, March, April, you might have cuts there. But this year would be too much unless there's a crisis, and nobody is talking about such bad things.
Correct. Correct. So what does it mean for markets then?
So markets are okay.
It will be sideways
first of
over
all,
the next 1
our
year?
market has gone nowhere. Please, remove this line that we are at all-time high. Because our average return in rupee terms for the last 5 years, some 10 years, some 15, 20 years, 25 years, always ends up in 12, 13, 14% per annum. Abhi bhi aap dekh lo, 5 year it will be something like that. Now what is return for this year, calendar year? Nifty, how much? Tell?
No, but
6,
largely
7%. It's from March. But 6-month return is some 7-8%. If you look at last year's return, 4%. So our annualized return expectation is 13-14%. In that 13-14% return which is made, normally over a cycle which might be 7 years or 8 years, chalo, jo bhi le lo, 8 years, 7 years, some because it keeps changing. Broadly, you have one very bad year. And that year is so bad that it takes away the returns of the previous year also, correct? Because it's that. So that means in a 7-year cycle, you are actually making returns in 4 or 5 years,
Correct.
maybe 5 years. But the 7-year return is 14% per annum.
Correct.
That means in the good years, you make more than 14%. You
Correct.
make 16, 17%, and then you have 2 bad years or 1 bad year which
Will
blows
take away.
back.
Correct.
So therefore, if these are good years, you're supposed to make 18, 20%. And then one day we lose some.
No, that is the question.
But
No,
right
so are
now-
we at a position
No, why
that
are we
it
at
will be
that?
a good year?
I'm saying therefore there's no all-time high which has to be, we have to worry about. It is still below average even for a normal 7-year average, forget about a 5-year average. So the fact that it turned in March can be that because it did badly till March, so usko compensate kiya, it doesn't show anything about the future, that you overdid the bearishness, who knows. But we have this bigger benefit that we didn't have before, which is this China flows. On our normal, when we were normal and we didn't have these big events, not events, but these big developments,
Right.
we were doing 12-14%. Now somebody can say, why do you think 12-14 in itself is okay? It is okay in terms of GDP growth, it is okay mostly in terms of corporate earnings growth, it is okay in terms of equity risk premium over debt. So that number doesn't look wild ki, okay, you got 14 in the past, but why?
Right.
That also looks okay. And even US, I saw for 25 years, has given something like 8% or 7 point some 7 or 8. So that means mota mati, that is also 12% in rupee terms. So 13-14 in rupee going forward is not unreasonable, including the bad years.
Sure. But then that you could have said last year also, or the year before that also.
Actually, you would have made
So-
money. What I'm saying is, over time, you make money rather than not make money.
Sure.
When you don't make money, unless it is an incredibly bad year, it is a handleable year. That very bad year which comes every now and then, that is not looking near right now.
Sure.
Because 2 years you've been flattish, not flat but whatever, much below average.
Sure.
And you are getting this benefit of China flows, and the other developments are also looking pro-India in terms of all these
Sure,
things.
sure.
So why should we think today that the bad year which comes every 5-7 years
Is this year.
and
Doesn't
actually technically it happened in 20 for maybe
Right.
1 week,
Right.
but it happened. Now whether that is correct to classify it and say okay good, finished, and now start, we will
Right.
do like that
Right.
as bullish people.
So now looking at your framework of looking at opportunity segments, sectors probabilistically, where is the highest probability of maximum gain and where is the highest probability of maximum pain?
So pain, one part, so we basically like 3 big picture themes, which is financials, consumer and IT.
That is forever true.
Or that's what I'm saying. So today and for 1 year we've not had IT. And we are pushing our thing saying now we are not having it for another 3-6 months. If you saw last week, 6 brokers on the same day downgraded earnings for every company and the sector. That was JP Morgan and
Right.
Jefferies and JM,
Right.
HSBC and whoever. How come all the 6 downgraded together? That means somebody called them. Who are these companies which call? Are these big companies saying, sorry, your numbers are very off. On the day of our result, we don't want to be
Look
seen.
bad.
We don't want to be seen as massively underperforming. what you will call, तो बेचारों को पहले ही करा दिया that you please cut.
So that they're
Otherwise,
in sync with analyst estimates.
so the analysts have been, so that the analysts will look smart and the companies will look that they have not beaten, they have not
Not matched
expectation,
analyst expectations.
But that is because now they've been cut. Now our public is very bullish, or some foreigners are very bullish, but we have seen that these things don't last 2 months or 3 months. When things go bad, they go bad for a year at least. Look at it. If some big company comes and after some 8, 10, 12 quarters of good performance basically disappoints you, it is highly unlikely the next quarter they say, no, sorry, it's okay, now everything is okay.
Yeah.
Generally, it means that you are now for 3-6 months going to recover from this, maybe reset your guidance and expectations, and then some new valuation will come which will look like low, and then you will start. It's like many analysts come and say now this, if a sector is doing badly, they will come and say, but now the valuations are at average. तो मैं कहता हूँ good, but when are valuations below average? In these situations only.
Yeah.
So therefore, again, we are just playing by our book that we are not buying IT. So that means by definition now we have some 20% money which we used to have in IT.
But you replace with new IT.
That we have done actually very little,
select.
about 7-8%, which is Paytm and Zomato. But basically, therefore, it goes into, and we don't call Zomato IT, we call it consumer in our mind. So we have, and we call Paytm financial, because basically lending money. So in the end, it is going to the other two. So for us, it's simple that right now we are more bullish on financial. Consumer itself, actually the stories for this last quarter have been very bad. That the sales of ACs are down and the sales of consumer durables are down. But fortunately, we never had the consumer durable type consumer companies. We've had the small ticket consumption stories like McDonald's and which is Westlife or Pepsi, which also might be having less drink sales now for all we know because of this thing. And then this Titan we've had, which you can consider whatever. But broadly speaking, that we are not having the consumer durable thing, which are supposedly also doing badly.
Right.
So therefore, now that leaves really one sector, which is financials. And financials, the advantage is that if new FII money comes, then 35% has to go into financials. For them to buy our number one holding is very easy because it has not done anything for 2 years. But the company is doing well. And so, in theory, it can absorb all this money from a new investor who feels a bit nervous that he's buying when the market is high. And some broker can go and tell him, no, but sir, this stock has not done anything for 2 years and it is Samir's also big recommendation, so please buy it.
Sure. So your faith in the darling company continues?
Yeah. Right now, so definitely I have to make up for the last 3 years.
Sure. Okay. So you, I know that you're not a very big fan of industrials and infrastructure, etc.
Infrastructure, we are not.
But in industrials, what is the scene? Because there is a lot of talk about private capex picking up. Many of these stocks are like, perhaps front-ended a lot of growth that is yet to come over the next 12 months or 18 months.
So we bought L&T because one of our guys in our firm did some basic analysis. Anyway, everybody likes it, but we in between had not had it. What we did was we saw the last 4 elections. That is 2004, 9, 14 and 19. And L&T always outperforms 1 year before
elections because of the order acceleration.
And people getting. And then we said, okay, let's see what it does from that day or that month end for the next 4 years. In 3 out of 4 years, it has underperformed.
Right.
And only in the...
Why are you saying this on a TV channel now?
I own it now. I just bought it on this logic. I tell my logic to everybody. On the 4 to 8 only, it outperformed when the whole infra and this thing was. So, 1 year, let's see now how it goes. Bottom line is, what I'm saying, we also want to buy some of the CAP, good infra, investment related stocks. But over time, we have realized that we don't want companies where the government is the biggest customer.
Right.
Or that the things are being done for the government. Because there the working capital cycles are long, and if they are not long, then the promoter gets confidence that now he's getting paid on time, and then next round he doesn't get paid on time. In the end, he's not getting paid on time, which will create so many troubles for him. And also because of L1 and all, you really don't. You make it in the steepest of bull run, but it doesn't last, at least in my history. So broadly, we remain here and we say that financials will, participate indirectly in.
But how about this, ABB, Siemens, Thermax, those, which is essentially riding on the manufacturing side of
So Siemens,
capex.
though, we will not buy because of very poor CG. And otherwise also they are expensive, so it's okay. Please remember our one slide that we always use. 150 companies do so well that owning the 150th company is a blessing, and very rarely have we outperformed even the 150th best performing stock from the index. And other fund managers have mostly never outperformed. And I have also outperformed only 2-3 years out of 18. That means the fund is not able to outperform the performance of the 150th best stock of our market. And even the US guys can't, because the top 1/3 do so well. So
that itself is a
so
good
what I'm saying
opportunity.
is you can buy something else, because so many stocks do well. Ex ante you don't know, but so many can do well and end up doing well. That if you don't like one stock, it should not change your life, because it won't be the only one which does well. That's what we mean.
Sure. So one question on Zomato, especially since you said that you look at it as a consumer stock, and you have been allergic to expensive consumer companies. Now, if you think of Zomato as a consumer company, in terms of valuation, it'll look probably worse than some of the other companies. So how do you look at it?
No, because see, the idea was that when we bought it, first of all, it was 52 rupees, and the idea was it has 1 billion in cash. And we bought it when they became good corporate citizens by saying that we will not invest in other loss-making companies, and we will restrict it to Blinkit. And in Blinkit also, that quarter, they said that our investment will be some 700 kitne crores instead of whatever people thought. The stock went limit up. We bought after it went limit up. It went limit up from 42 or something. And then they also said that we will do analyst call and we will meet, manage. Previously, they were living in their own dreamland. So we thought that was a good turning point. So now the thing is that this year the consumer has been slow in terms of new guys coming online, but the cash is still there. Blinkit, I think, is a good investment according to me. And right now you're looking at it more as an optionality. But it is not as good as it was at 52. So please be careful.
Sure. ITC, has it run its course? Is there more money?
ITC, we are running with it. We have made some 85-90%. That was one of the stocks we had bought in 2020 and or whenever it was, 230, 220. Now we let it be. We call it high confidence reasonable return. Reasonable return means till a few months ago even 10% was reasonable. Now maybe 15% is reasonable because the market has changed. Otherwise, in Feb, March, anything which was up was considered reasonable, right?
Correct.
So right now it is in the reasonable zone.
You think the valuation gap between, say, ITC versus HUL or that entire consumer pack, how much can it get bridged?
It cannot get bridged fully, or even because that is just the nature of the fact that you'll always be worried about government. You'll be worried about the ESG guys coming back. But you see, this exposed the ESG issue, which, I think you were at that this thing when I presented in Mumbai at one of the hotels, I think Traders Carnival, where I said that how if the ESG, the stocks that you think are bad from an ESG point, if they start performing well, what will you do?
Correct.
For many years they were doing badly, so it was easy to act holier than thou and say, I don't buy coal and I don't buy oil and gas because they are bad for something, because the stock itself was also doing badly.
Correct.
As soon as stock started doing well, everybody got confused.
Sure.
We fortunately come with cleaner understanding that these things are too different, and unless the client is saying some of these things, some of them are bad as sustainable business, that is different. But like if you're selling liquor, now what can we do? Or some people don't
Correct.
buy hotel stocks. That may
Sure.
be more with the religion and other things. But otherwise, what can we? If it's a good business and sustainable. But this risk will be there because X% of the world will look at that and they are potential buyers of these stocks. So the discount will remain. But as long as it doesn't expand now and you get your earnings,
Yeah.
that's okay. And it looks that the government has taken the stance that there is no need to
Hike.
totally extract everything that you can via taxes.
Sure. One last question. Over the last 2 years, actually last 1 year, have you added any rules to your investment book?
No.
Any new learnings?
So the new learnings are that last year we thought that we did not have enough of value stocks. So we try to cover all the angles because our model has been consistency, not by saying that I will beat the market over 5 years, but broadly want to beat it every year. So from 2005 to now, nearly every year we've been shortlisted for the best India fund by Eureka Hedge. That consistency is not easy to get, but you have to cover your angles.
Sure.
So one angle we said is that please, just because we are these growth guys, we like Paytm and we like Zomato, does not mean we should not like some
The
other
ITC.
stock. ITC though we had by chance a little bit before. But we have even looked at oil and gas and everything else, which we would have been always untouchable all our life.
Are you bullish on oil and gas now?
Now we don't talk about everything, but we own one of them, one of these PSUs.
Okay.
Because we said, if it is very cheap, let's
Ignore it.
Hey, let's not just say we don't buy. Because why can't I buy two stocks, one for its incredible growth and one for its incredible value? And in fact, one of the reasons given in our logic note was that this company in oil and gas, which is so big and has so much distribution, its market cap was lower than Zomato. So I said, this is a bit too much.
Right.
But you can have two conflicting ideas in your brain
Sure.
because that is how you maneuver through different periods.
Sure. That's all, Samir. Such a pleasure talking to you
Thank you
as
very much.
always. Thank you so much.
Thanks a lot.